Welcome to the Sterling Trading Tech Roundtable video series. My name is Andrew Actman. I'm the Managing Director of Business Development for Sterling. As a global provider of trading and compliance solutions, we thought it was important, especially during this time, to continue to have industry conversations. This post-STA conference virtual roundtable recap will highlight takeaways from the options panel that assess market volatility, and options veterans shared their visions on its future. Thank you for joining our roundtable, gentlemen. To get started, please introduce yourself, starting with Pat.
Thank you, Andrew. I'm Pat Hickey. I'm the Managing Director of Participant Services and Solutions at the Options Clearing Corporation. And it's great to be here today to recap a great panel from a couple of weeks back.
Great. We appreciate you joining us. Over to you, Paul.
Paul Jiganti, Managing Director of Business Development and Market Structure Strategy at IMC. Again, just like Pat, happy to be here. Look forward to the conversation. Appreciate you joining.
And then Sandor.
Hi, I'm Sandor. I'm a principal at Jain Street, and I oversee options trading at Jain Street. And back in the day, in the late 90s, was an options trader on the floor of the SIBO.
Great. And then Ravi, we'll finish off with you.
Sorry, should unmute myself. I'm Ravi Jain. I'm Director of Risk and Derivative Products at Sterling Trading Tech, ex-options trader, ex-risk manager, now building some interesting cutting-edge risk technology, in particular for the options world.
Great. Thank you all for joining us again, and we'll get right into it. So the first question, and we'll start with Pat here, is what was the biggest takeaway from the STA Options panel?
Well, I'd be remiss if I didn't mention that I think that we were able to show everybody who watched the panel what a concrete saw in a trash truck emptying a dumpster 10 feet away sounds like in a virtual conference setting. So, but aside from that, it was really enlightening, even to me, having been in the industry for so long, to just keep encountering new paradigms and shifts and what we can do to help the industry tackle them to see some better outcomes. We talked about the floors closing as a result of COVID, and a lot of the workflows that the industry had depended on for decades was no longer available to them, and how the industry had to adjust. And then at the same time, now that the floors are reopening, what changed? Did it go back to what it looked like in the beginning, or were some of the changes a little bit sticky, and will they remain going forward?
Yeah, I think that's a great point. I mean, I think we're all seeing, as a tech provider, we're all seeing how folks are changing, right, and adapting to this new environment, not only from a trading, but also from a risk perspective, and how you can do those things in a different way based on, where you are and where you're working from. So Paul, over to you. What were your big takeaways?
I thought that what was interesting was really where the floor closings and the change really manifests itself alongside and almost in conjunction with the retail re-engagement or hyper engagement that we had never seen before. So I guess not but hyper, and watching that it's continued throughout the next 6 months, and you're trying to vet whether all of our ideas, trying to see if we believe, and everybody had a little slightly different perspective on whether this is a healthy thing for the marketplace, and whether we have any control of that, and what's next. And I thought that was a really fun discussion to have.
Yeah, and I can tell you, we have never had so many requests from an options functionality and trading perspective than we have over these last 4 months. So we've seen, from the one end on the trading side, people looking to get that access. Sandor, up to you. Ooh, I think are you muted?
Sorry about that.
There we
I would
go.
say two things really stood out to me. One was the trade-off of risk and liquidity. I think Paul and I and the gentleman from Dash all sort of talked about that from different directions, whether the risk in question was electronic risk or adverse selection risk of putting up a big trade upstairs on our desk, and the difficulty of knowing what you're going to end up with after it's been electronically crossed. The volatility risk of the market moves and how that translated through to much wider markets, as we noted, 20 times wider in the S&P, and in some cases 30 or more times wider than normal in something like the NDX. And then the other thing that really stood out to me was honestly the robustness and high quality of the liquidity that the options market writ large was able to provide, despite the chaos in the markets, despite the floor being closed, despite the market moving some of the biggest moves that we've seen of all time. I think it was a real challenge. And if you were going to sort of stress test the industry, the options market making and liquidity providing industry, whether you're talking about electronic market makers, whether you're talking about an upstairs desk, I think overall the industry really came through that stress test with a strong A.
Yeah, I think that's great. And I think it's a great lead in for Ravi, a former risk guy. So Ravi, what are your thoughts?
So, speaking to what Paul also mentioned about the retail participation, what we've seen is, especially on the risk side, a bit of a panic in the market in terms of how to manage the risk of all these new entrants in the market, and a lot of them being relatively unsophisticated, number one, and number two, that it skewed the volatility. So how do you read that in terms of risk analysis? And so we've seen a lot of more interest in people trying to look for better risk analytics, in particular in real time, to be able to manage this new entrance into the market, especially because a lot of them are day trading, and or they're holding positions for very, very short periods of time. And we've seen all sorts of effects of many of them not even knowing what to do with the option positions they have on. I've seen everything from people forgetting to exercise, not even realizing what to do when they put on a spread because somebody told them to put on a spread, and resulting in a stock position that they didn't even know they had. All sorts of stuff like that. And so it's a challenge for those that have to manage the risk of this new clientele.
Thanks, Ravi. And then we'll jump back into really the second and final question, which is always the most interesting, which is, what does the future look like? What does it look like from a options trading perspective, volatility perspective? What does the future hold? Sandor, we'll start with you.
Well, I think the one thing that we know is that the market is expecting volatility to continue. I checked it up actually right before we spoke today, just to make sure it was still true. And sure enough, the market is still pricing that 6-month volatility up near 28 on a VIX adjusted terms, which is of course more than double what you would have gotten in a more quiet period. So I think the market is definitely expecting, whether it's due to coronavirus, whether it's due to geopolitics, macroeconomics, bubble dynamics due to retail or technology being so exciting, for one reason or another, or maybe it's a combination of all of the above, I think the market definitely expects heightened volatility and exciting options trading for a long time to come.
I appreciate it. And by the way, you do have the best background of anybody on the Zoom call. Pat, over to you.
Yeah, I think that what does the future hold? I think that this theme of the new breed of retail trading is going to persist. I think that on the panel we got a chance to kind of compare what happened with the floors and them closing down and then reopening. What changed? Does it go back to the old standard of what trading was like? And we could kind of talk about are the same kind of themes gonna have? Should we be talking about those same kinds of themes with this with this increased participation of retail? the overall volumes have been up 50% on average for ADV, north of 25 million contracts a day. And that is more than driven by these retail traders. The share of 1 and 2 contract trades of that 25 million plus volume is up threefold. So they are. So I'd like to look into how much more 1 and 2 lots are actually coming in to Ravi's point, and the ability to risk manage those. But a big theme is what happens when people go back to work and sports betting is back and can compete with these 1 and 2 lot traders. Do they all go back to DraftKings or whatever? And I think even since the panel, we're seeing evidence that this does have. There is evidence that this is going to be around for a while. There was a news story about Fidelity increasing their headcount by 15% in the coming years to accommodate what they see as growth in their business. It's not just the Robin Hoods and the app-driven brokerages. It's all brokerages, and it's in all regions of the world as well too.
Yeah, no, I think that's a great point. And us as a tech firm, we're trying to understand, all right, how long is this going to be around for? Do we need additional capacity to handle? So we have a little bit of a different approach, but it's the same conversation, which is, all right, is this for real, or is this staying? And if so, for how long? Mm-hmm. Paul, over to you.
So I'm going to build on what Sandor said. I think the future of trading is potentially a 28 vol, but without the volatility of the vol, it's going to feel a lot more like a 16. And what it does do is it's probably likely to keep the dispersion going. The single stocks names are going to be more exciting going forward. And it's largely driven by these story stocks, which make it entertaining to trade. I'm hoping there are more investors than they are day traders, but that's probably just my optimistic view of the world, and that these people have joined the investment class. And I got my fingers crossed that that's actually the case.
Yeah, and Ravi, I saw you shaking your head as well. I'm assuming you're in agreement. Let's hear your thoughts.
What's interesting to me is what's going to happen to the vol surface if these traders continue to learn, to mature, because till now, a majority of them are only allowed to buy options. If you look at some of these online platforms, they only can buy options. So it's made the vol skew, especially on single stocks, change significantly. As they are allowed to start selling options, or they become more educated in terms of the trading, do we see a significant shift in the skew and volatility? It'd be interesting to see.
Yeah, listen, thank you, Ravi, and really thank you, everyone. I think the one takeaway for me is collectively, you all seem pretty positive on what the outlook in the option space looks like. And look, I hope we can look back a year from now and still see consistency in the marketplace and people being successful. So we appreciate your time and thank you for joining the roundtable.
Thank you.
Thanks, Andrew.
Thank you.